Good afternoon, ladies and gentlemen, and welcome to the Fulham Shore PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted and publish responses where it's appropriate to do so. We'll notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Nick Wong, CFO, Nabil Macanaris, and David Page from Fulham Shore PLC. Good afternoon to you all.
Good afternoon. Welcome everybody to the Fulham Shore investor presentation. I hope you can all see the slides, and we will be switching off our cameras in a minute and be on voice only so you can see a bigger screen once we get started. So if we go to the introduction, Mr. Moore. We'll switch off the camera. We established Fulham Shore in 2012 to look for and develop restaurant concepts to start with in the UK. And we currently have 55 Francomancas, and we have 20 Real Greeks. We bought the Real Greek when it was 6, and we bought Francomanca when it was 11 strong. We looked for brands that had a scalable business model and were defensive in terms of a national economic malaise, and so we chose brands that were between 10 and 16 pounds a head. We're currently capitalized at about 110, 120 million pounds, and we have all got great experience in the restaurant business in the UK and abroad. Nabil and I have been together since 1986. Nick has worked with us for the last 15 years. So we're probably the most experienced team in the UK in running restaurants. Next page, which is our strategy. We wanted to develop some restaurant businesses that we were proud of and we're capable of expanding and growing both restaurant numbers and profits. We intended to grow the shareholder value by increasing both the profits and the value of each individual of our restaurant businesses that we bought, and we own 2 currently. It sounds a bit twee, but we encourage the management to see their individual restaurant as something to be proud of and not to shelter behind the fact that they're a chain. So they should be proud of their individual location. We increase shareholder value by adding to the number of restaurants we own. And of course, that means increasing the number of sites within the UK and abroad. We're well known in both businesses for reinvesting the profits and keeping the prices down. Value proposition drives volume. In the first stage of this sort of business model, you actually make less money per site than, say, our competitors. But because our prices are so good and our food is so good, we have very high restaurant volumes in our restaurants. Well over 2,000 people a week visit our average restaurant. Compared to, say, the average in the UK was about 1,200 or 1,300. We're very proud of our restaurants, and I'm proud of our staff, and we incentivize our staff by various profit-sharing schemes. And we just announced this morning that in December we intend, subject to the government not interfering with our business again, we intend to state our dividend policy for the half year and then the full year in March next year. So, Mr. Wong, would you like to tell everybody why Francomanca is so brilliant on the next page?
Yes, of course. Francomanca is an award-winning Neapolitan sourdough pizza operator. We serve fantastic pizzas with great value for money. The key point is it uses a lot of fresh ingredients, and it keeps the menu very simple. So there are only 7 core pizzas on the menu, with various specials that are different in every single restaurant. Our chefs have a choice of different specials that they prepare. every day. We now operate 55 pizzeria across the UK, up from 53 at the end of the last financial year in March 2021. Our long-term ambition for this business is to take it to over 180 Francomanca pizzeria across the UK. Under the ownership of Fulham Shaw, we've now grown this business from 11 restaurants to 55. We've won numerous awards in the sector, including last year, the Casual Dining Awards, Best Family Dining Experience in Francomanca. And we are very proud of our team members who've supported the business all the way through the lifetime of this brand. We've grown our customer base, and we have a lot of loyal customers. We now serve over 100,000 pizzas a week, and we sell over £1 million worth of dips alone every year. Since the lockdown, our brand has been trading exceptionally well in the suburban areas, one would expect, and regional town centres, while the commuters have been working from home. But we expect many of these commuters to be back in the city centres, especially central London, over the next few months. Our typical model for the Francomanca is relatively simple. The capital expenditure for each unit is about £650,000 to build, and we always target the 3-year cash payback. Since the lockdown, we've seen exceptional opportunities with property, and it's given us the ability to reduce in the short term the capital expenditure for new sites. The reason for this is mainly from some landlord incentives, as there are more units available across the UK. And also, we are able to take over units that's been occupied by various previous operators. So they will be fitted out already for restaurant operation, maybe some kitchen equipment is already there. So the extract would be already there, and that reduces our initial capital expenditure for the business in the short term. So currently, we've got 2 restaurants in build, one in Blackheath in London and the other one in Baker Street. These are expected to open in the next couple of months. And recently, we've started investing in our franchise internationally, and we've had numerous people contacting us from overseas over the last few years, and now we're really engaging with them to build this opportunity to franchise Francomanca across the world. We'll start initially more focused around the Mediterranean area to prove the concept, and we'll be looking to sort of further afield over the next couple of years. In terms of customer engagement, we launched our loyalty app at the back end of 2019, so really only a few months before COVID hit in March 2020. We now have over 250,000 customers on our loyalty app in Francomanca, and that's been up from 110,000 back in March 2020. So a significant number have really sort of joined our family over the pandemic 18 months and the lockdowns. This loyalty app allows our customers to earn stamps from all our sales channels, including the 2 delivery channels, Uber Eats and Deliveroo. Our website traffic has increased over the last couple of years by 20%. This has been driven by all the activities we have introduced during the last 18 months: pizza kits, gift cards, recipes, virtual queues, etc. We also launched our virtual queuing system last year after the first lockdown with the reopening, which allowed our customers to join the queue from the desk or within 500 meters of a restaurant and receive an SMS when the table is ready. This has allowed our customers to queue up because our restaurants are relatively small in footprint, but yet they don't need to queue outdoors as they previously had to. All of these systems that we've invested in over the last few years feed into our sort of single customer view system, So it allows us to better understand our customers' behaviors, what they prefer. We can personalize promotions if they would like some of the marketing that we send. And we're also able to target and reactivate lapsed customers, those who haven't been to a restaurant for a number of years.
Well done, Nick. I have to explain that Nick's got a cold and a cough. He hasn't got COVID, so he's done very well on that, on those couple of slides. Nabil, would you like to do the next slide, which is explaining the Real Greek and also very busy restaurants? Over to you.
Yeah, sure. The Real Greek serve Eastern Mediterranean food. It's operating 20 restaurants. We just opened one a few weeks ago in Norwich, which is operating above expectation. We work with the celebrity chef Tonya Buxton. She developed our menu, and we're one of the first company that have launched a vegan, separate standalone vegan menu. That was launched in 2018 and is doing extremely well. Fulham Shore have grown the brand from 6 to 20, so over triple its size since we took over. We are currently in 2021. We have 19 restaurants, as I said to you earlier on. We just opened one in Norwich, and we currently, we believe we're going to go on site for another restaurant in Bluewater soon. And we're currently in negotiation with a couple of more sites. Ideally, we would like to grow the Real Greek to a 50 site. Real Greek operates extremely well in shopping centre, and average capex is about 750,000, and it does return back on capital within 2-3 years. Some of it 2 years, some of it 3 years. So it's a good generating cash. We happy to expand outside London because the name explain to people what they're gonna get. So you don't need to market the name. The signage by itself, it tells you what you're gonna get once you walk in. The idea is to expand outside London. We're looking at Newcastle, Scotland, Liverpool, Manchester, Oxford, Cambridge, all of the big cities with unis that we believe we're going to do well there. The Real Greek typically required a bigger restaurant than Franco Manca, hence why the capex is slightly more. And we also try to find restaurant that with outside seating and terrace, which fit very well with the cuisine that we're serving in the Real Greek. We also have done a launching during COVID. Our retail or grocery online, which is operated very well during COVID. Slowing down a bit now. Well, similar things with delivery when during COVID that was extremely high numbers, and now slowing down a bit. Still more than pre-COVID, but it's not as much as obviously used to be during the lockdown.
Great, thanks. I'll do the next page on our team members and how we incentivize them. Nick, are you? How's your cough? Are you all right to do the page after that with the highlights?
Yes, of course.
Yeah. Okay. So page 8. We obviously can't do anything without the people who work in the restaurants. So we try and attract and pay the best in the business. For instance, during COVID, as Nabil has mentioned, the business shifted, and we found that, especially in Franco Manca, we had a really great business on our hands, and the customers loved our product. And some of the restaurants were more than twice as busy as they were normally pre-lockdown. So we brought back all the kitchen staff, and to incentivize them to get off the sofa, Rishi was paying them 80% straight to them. We paid them 120% of their previous salary. So that got them back off the sofa and into our restaurants. And so we were then in a very good position with almost all the Franco Manca and a majority of the Greek, in that we already had our kitchen staff there and working, and we worked them all the way through the various lockdowns. And so when we came out of lockdown finally in May, June, July this year, in various stages, we already had our kitchen force in place, unlike pub operators who had to start from scratch again. So we were very fortunate in that we were able to retain the majority of our workforce, albeit we are paying them much more money than we were before COVID hit. Saying that, we announced this morning in our AGM that the last 3 or 4 weeks our sales have been 30% plus increase on 2019. So if you have our sales running at 30% more than 2019, we can afford to pay the staff more. So as we also said this morning, it hasn't really affected our margins. So we have team members that have been with us for as long as the businesses have been going. Last time we looked, over 50% of them had shares by one means or another. So they're really committed to our business. We have cash bonus schemes, we have share option schemes, anything to reward them for their hard work. We have regional and centralized and branch by branch incentive schemes. We're constantly looking for different ways to keep and poach, dare I say poach, and then keep the best staff. And we've raised, as I say, we've raised our wages across the board recently. So we now think we are paying the best in the industry. So what we did have 3 or 4 months ago, which was some staff shortages when we opened in July, have almost disappeared. We have an option scheme within the company for managers, of which is partially used, and if it was used to the maximum, it would be 15% dilutive. But it's not to the maximum. Mr. Wong, would you like to read page 9, which is now very historic, but it gives people an idea of how we weathered the lockdown financially?
Yes. Our most recent set of results was for the year ended 28th of March 2021. So as David says, it is some time ago. And we updated the market today regarding the first half of FY22, and our revenues has improved relative to 2019 before COVID, from 36 million 39. However, in the last financial year, it was really a year of 4 different quarters. The first quarter we were shut for many weeks as the government gave the closing order for the first lockdown. We started doing delivery and takeaway sales in both our businesses at the end of April 2020, and slowly reopened each restaurants for takeaway and delivery during that first lockdown. After lockdown in the summer, we had the benefit of Eat Out to Help Out, and many customers back out in our restaurants, and it was a fantastic second quarter for us, which helped us cover much of the losses at EBITDA level that we had in the first quarter. The third quarter was one of constant change. We had the tier system, and the government told us each week or each fortnight which region can open and which region had to shut for dining in. However, by then our delivery and takeaway business has been so strong, and our staff has been fantastic in supporting that side of the business, that we were able to run that profitably at EBITDA level. And of course, then the fourth quarter, January to March 2021, was the third lockdown that we experienced. Once again, we had delivery with takeaway in many of our restaurants. And during that time, we saw some of our suburban restaurants trade with only delivery and takeaway at higher levels than they had in the previous year. So we had some very mixed results, but really to the positive given the circumstances we were trading in. We We did, during that financial year, still open 2 new Francomanca pizzerias, and we opened 1 Real Greek during that time. Since the year ends, we've now opened 2 more Francomancas, one in Glasgow and Holborn, and we've opened a Real Greek in Norwich a few weeks ago. We ended our financial year with net debt of 3.6 million. And that was an improvement on the previous year, March 2020, when we had 9.5 million of net debt. We announced today that our net debt is now a net cash level of just over 5 million pounds. So a significant swing since pre-COVID and also post-lockdown period. I'll quickly take you through our banking facilities as we're talking about funding and debt. We've got various facilities at the moment, totaling 24.27 million. 14.25 of that is the RCF facility that we've had for a number of years to support our opening program. During the height of the lockdown last year, we took out a government guaranteed CL bill loan from HSBC of 10.7 million. And we've actually made a repayment just under 1.5 million so far on that facility. So we now have just under 9.3 million outstanding. And we've also got an overdraft of 0.75. Our covenants for the last financial year were much tighter than previously because of the lockdown. However, we had all our covenant tests waived during the lockdown and waived until September 21. By June 2021, all our covenants passed, even though the waiver was in place. So at this point, we are in the process of negotiating with HSBC to repay the coronavirus business loan that's supported by government, because we no longer require that support. The clarity post-lockdown is here. And we are looking to extend our RCF facility to 17 million pounds and for a further 3 years to support our opening program. This will give us the opportunity to speed up our opening program if we choose to do so, or look at potential small property packages that we can take advantage of because of various opportunities out there in the marketplace right now. I'll hand back to David, who would cover the current trading and outlook.
Okay, thank you, Nick. So the current trading is very good and very buoyant. As we've said a couple of times, the group volumes are 33% ahead of 2019 as we speak, and this is without the West End and city centre locations fully opened. As Nick has said, in the half year just announced, our volume was 39 million pounds in sales, and this is up from 36 million pounds in the equivalent period in 2019. As previously mentioned, we've opened in Holborn, Glasgow and Norwich. We're currently building in Francomanca in Blackheath Village and Baker Street in London, and we have hope to start building in Bluewater Shopping Centre in Kent next week because we've exchanged contracts. We are building our pipeline for the end of this financial year, where we have told the market we're going to open around 10, but we've got 16 in legal negotiations. So we may open 10, we may open 1 or 2 more, but we'll see how it goes towards the end of the financial year at the end of March. But we'll certainly have a full year of openings in the next financial year, where we hope to raise the level from the bar from 10 and open a lot more than 10. As Nick intimated, there are lots of property opportunities because of the collapse in retail shopping. You can now, because of changing planning laws, we can open a restaurant in the next retail premises. We don't actually have to go for planning. So the cachet that belongs to a restaurant use is gone. So there are a hell of a lot more premises that are available for us to open in, not just ex-restaurants. Ex-restaurants are better for us, actually. They're cheaper because they've already got the loos and the extract and the shop, typical restaurant shop front with probably open windows, so we don't have to pay for all that. So converting a retail shop and a bank is more expensive, but then sometimes they are in the best positions in town, like in Baker Street. It's an ex-bank and it was on a corner and it's opposite the cinema, so that will be a more expensive fit out than taking over, say, a Bill's or a Carluccio's or a Café Rouge. As we said in our statement, we're in the final throes of agreeing a couple of international territories around the Mediterranean where we will open Francomanca franchises. And as Nick has pointed out, with our new banking arrangements in place before Christmas, and our cash, 5 million cash we've got in the bank at the moment, we will have headroom of more money than actually we need to open restaurants organically. So we can buy packages of sites if we need to. And it will also fund what we announced today, which is a dividend policy, which we'll announce the start of in December and the amount in December. So we are well funded. We've got 2 businesses that the public are flocking back to, and we are spreading our footprint around the UK. As you can see from the last slide, we're heavily in London at the moment, but there are lots of towns and cities in the UK where we can open both of our businesses. And we are targeting about 230 sites in total on a base of the 75 we have at the moment. So there's plenty of room over the next few years to expand both businesses throughout the UK. And that's the end of our presentation. Thank you very much for listening. And there's a Q&A button, which I actually can't see on my screen.
That's brilliant. David, Nick, Nabil, thank you so much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you to the opportunity to provide your feedback.
David, can you see the question?
Can better understand your views and expectations.
No, I can't.
So David, on the bottom, there's a little chat button at the bottom.
Oh yeah,
David.
Very good. Yeah.
If you just click on that. Done. Can I ask you, David, is it possible to read out the questions and give a response where it's appropriate to do so?
Oh yeah. Yeah.
Perfect. Thank you.
I'll start with the first one. Shall I?
Yes, please, sir.
Okay. This is from Michael. You rolled out 2 new Real Greek per year versus a more aggressive plan with Francomanca. Would you be better sticking to one concept and dedicate all your capital and energy to a Francomanca rollout? Very good question. Well, both businesses show the same return on capital invested, which is a 3-year or less payback. So they're very similar in terms of financial modeling. We think you're correct in your underlying question in that the UK can possibly bear up to about 200 Francomanca and possibly only 50 Real Greek. So, we asked this question many times ourselves, and if the Real Greek stuttered and fell below the return on capital of Francomanca, we put our capital towards Francomanca, but actually at the moment they're pretty neck and neck. So in their return on investment. So and we've got 2 brands, and we've got 2 management teams. Both of them like opening stores, and it gives them a career path within the businesses. So believe me, we do have this debate between the brands, and in fact they're quite competitive with each other. So they have their debate with each other. So I hope that answers your question. We think about it all the time. Oh dear, Chris, a question. What does the time frame from finding a new site to physically opening the venue?
Can I answer that?
Yeah.
Well,
I mean, we pull our hair out. Go on, Bill.
It depends where it is, Chris. If we're dealing with a big landlord like Westfield or Bluewater or Manchester Trafford Centre or Aviva, that could
Careful,
take
Nabil.
forever.
Careful, they might be on the call. Don't be
but
rude
it's
to them.
fine.
They
I
might
mean,
be on
it
the
can
call.
take-
Be
it
careful
can
what you say.
take- the legal part alone can take up to 3 months sometimes. If you're dealing with an individual landlord, which is have some legal representative that they will answer questions faster, therefore the legal can take up to 4 weeks. So it's most likely the legal is the one take the most of the time. And once we agree legals, planning is straightforward. Then build, it takes anything between 5 weeks to 10 weeks to build the restaurant. So as I said, subject to the legals, how fast the movement of legals and agreeing head of terms, the build, it takes anything between 5 to 10 weeks. 5 weeks, that's mean we're taking an existing restaurant, as David and Nick said early on, where there is extracts, electricity, plumbing, toilet, floor, glazing, shop front. So that takes about maybe 4 to 5 weeks. If you're taking a shell unit that you need to fit it up from A to Z, that can take up to 10 weeks.
Yeah. I mean, you know, we bought and opened restaurants in our past for lives in 6 or 7 weeks. But then I remember Guildford took me 10 years of looking, 3 years of getting planning permission, and then 3 months to open the restaurant. So, you know, each site is different, and you have to be very patient with everybody involved. I'll try and rattle through the next few questions, because otherwise we'll spend a bit of time. Are you looking to take over other brands or ideas? No, not with Fulham Shore, not at this moment, because we've got 2 great businesses and we want to expand them. How are you going to manage standards in franchises that are based in other countries? We have opening teams, we have regular inspections, we train the people from those other countries here, and then we, as I say, we send our opening teams there. Also, we've all done it before. We did it at Pizza Express and we did it at Gourmet Burger Kitchen. So we've done this before. And we've made.
We're also selecting
and as Nabil's saying,
operators.
Yeah, we select the people very carefully. A competitive landscape. Who do you see as your current prime competitors? We see anybody as a competitor that serves food between £10 and £16 in the UK, serves food well. So it's not just in our areas of cuisine. We're competing for a customer base with pubs. We're competing with everybody, because everybody's competing for the same spend. The competitive landscape is the best I've ever known, because a lot of people have gone out of business, a lot of sites are available, and it's a bit like 93 to 98. So it seems to us that this is a great period to expand for a number of reasons. There we go. Oh, yeah. Well, we as I said, Matt. As I said, I'm answering somebody called Matt. As I said in our presentation, we pay the best in the sector, and we have a trunk system that's got nothing to do with us. We have a trunk master, which in fact is employed by many other hospitality businesses, and they organise the trunk for all the staff, and it's shared equally. But we are paying the best in the business at the moment. And I think that's so far the end of the questions.
Thank you. Thank you, David, and Nick and Nabil for taking those questions submitted by investors. And thank you to those investors that have submitted questions. And of course, David, if there are any questions that perhaps haven't appeared through, what we'll do is we'll make those available to you post this meeting for your review. I know investor feedback is important to you, sir, and perhaps I can redirect investors to provide you with their thoughts and expectations. But before doing so, perhaps I could just ask for a few closing comments just to wrap up with.
Yeah. I think I speak for us three here that we're very proud of these businesses. Any criticism from a customer hurts enormously. We obviously constantly monitor social media to make sure that any poor experience in our restaurants is rectified. And I'm very glad I'm not in social media, because we had one last Saturday when we were frantically busy apparently in Wimbledon. Francesca And the customer said, "Why don't you put on more staff?" I wondered where that customer had been over the last 3 or 4 months. Obviously, there's a well-publicised dearth of staff. And so very luckily, I didn't respond on social media. I left it up to the professionals. But so we're really proud of these 2 businesses that we own. And we're looking forward to taking them to all around the UK. Because that's how we make the shareholders more money. And we keep the customers happy.
David, thank you very much indeed. And also thank you to Nick and to Nabil. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the Fulham Shore PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon to you all.